Good afternoon, everyone. Welcome to this Monday's Wealth Creation Show. Today, we're going to be discussing the importance of behavioural finance. And I think this is a really interesting topic. For me, I was looking into this in the lead up to this show. So it's a wee bit new for me. So, Jim, you'll be all too familiar with a lot of the things we're going to discuss today. But I think
I've probably done a lot of them.
Yeah. It's really about people's emotional approach to their financial decisions. And behavioural finance combines elements of psychology and economics to understand how your cognitive biases and the emotional factors that influence your financial decision making. So it's quite interesting, actually.
To put it in a more layman's terms, generally some people just get bent out of shape, and the emotion takes over completely when it comes down to a rational financial decision that should be taking place. And this is what I talk about, the commercial reality of a situation quite a lot, about, we are where we are right now, but you have to take that into account. And then here's a classic example about how this happens. When people go on a witch hunt, so when somebody goes on a witch hunt to try and get somebody back for something, and then you ask them, you say to them, so why are you doing this, and what do you expect to happen at the end of this? And they go, at the end of this, I don't expect anything to happen. I just want to prove myself right. And you're like, well, I know what's going to happen at the end of this. If you do what you're about to do, it's all going to fall apart. You're not going to have anything left, and therefore you're going to be picking up pieces off the ground. And then the person actually goes, I never really thought it like that. So it's behavioral finance is all about not letting the emotion get involved in your decision making process, and just taking a step back for a while. Absolutely, I get it straight away. I don't know if anybody else gets out there, but if you do, then give us a thumbs up or a number 5 in the comments or whatever, just to see you understand what we're talking about.
Yeah, show some reactions, guys, if this is making sense, or as we go through it, it kind of then falls into place for you, so that we know we're obviously on the right track. But yeah, definitely, traditional finance theory assumes that investors, and we'll refer a lot today about property investment because that's what we do, but obviously this goes to other things as well. But they assume that investors make rational decisions, and they make them solely based on maximising their wealth and things as well, which in an ideal world that should be. But behavioural finance then recognises that human behaviour obviously can deviate from that rationality.
Yeah. There and when it comes to property, the classic for property is when a lot of landlords get a really awkward tenant and it's not gone very well, and they get emotionally entrenched in the decision making, and therefore what they often say, here's what's happening right now with the legislation. With the rent controls, with everything else as well, everybody was going, I'm going to be selling up, I'm going to be selling up, I'm going to be selling up, and everybody was selling up. There's 400,000 properties in Scotland in 2021. In 2022, that's gone to 340,000 properties. That is a drop of 15%. By the way, Patrick Harvey, who said, oh, I don't see anything in terms of landlord registration, that was a complete fabricated lie that he said. Because it's clearly, that's their stats. 400,000 to 340,000 in 1 year. 60,000 is lost in the private renting sector. And then they're going on about the fact that homelessness is at a record high. Well, I'm no surprised, because 60,000 people that were in tenancies have just lost their homes because of that legislation. But I come back to saying a lot of people made emotional decisions. The emotional decision I made was, oh, maybe I should. And I went, whoa, wait a minute. Whoa. There's emotion happening here. Think about this, Jim. What could the ramifications be out of this? And I worked out over the next 10 years, my rent will go up by £196,000 a year. In 10 years' time, I'll be getting in if I increase my rents by 3% every single year. Happy days. There's a good emotional decision.
Yeah, that's a positive one, though.
But that's the same for everybody else.
Yeah.
It's exactly the same for everybody else out there. I mean, let's be honest, you don't need to increase your rents, but if you did increase them by just 3% every single year, where is it going to be in the compounded effect over the next 10 years? What are you going to have coming in over the next 10 years every single year if you increase them by 3% every year? Because 3% is just normal inflation when you think about it. So people should be expecting that anyway as a natural recourse. But I was gobsmacked. I was like, oh my God, Another £196,000 a year on my bottom line. Hello?
I know, and I think it's good for everyone if they're going to be implementing the rent increases and things to look at it and, like you say, forecast where you're going to be if this is what you're going to be implementing as we go forward, like the government's advising us to do so, and see where you fit with your own portfolio.
Yeah, Patrick Harvey's given me a wage increase, a salary increase of £196,000 a year in 10 years' time. Thank you, Patrick.
You mentioned there, Jim, about landlord registration stats, and the thing with that is they're referring to landlord registration stats, but a lot of landlords who have sold up and maybe exited will probably still be on the register. Do you know what I mean? They've maybe not taken the time to then go and remove themselves, or just let it naturally run its course and then end.
Yeah.
So they're not really accurate stats to be going by either, to be fair.
Well, I'm testing that out just now, actually.
Okay.
Just to see if they're actually picking up on the people that should be registered. I don't think they are, to be honest. They did pick one up, but it was only because the tenant actually had to phone the landlord of the property that I had just bought, and then landlord registration picked up and went, and when the landlord said, but I actually don't own that one anymore. So we'll see how long it takes for them to get the other 29 properties.
Yeah. So back to the behavioural finance and decision making, and we're going to look at the psychological factors. And as we say, investors are not always rational decision makers, and human psychology plays a significant role in shaping your financial behaviours. So emotions such as fear, greed, overconfidence, and these things could all lead to irrational decision making and causing individuals to buy or sell assets at prices that may not reflect their true value. And then that means you could be in trouble there when you're making financial decisions like that. Yeah.
You can see that right now in crypto.
Crypto's
gone through the roof, and every I don't know what, if I want a better word of what you call them, have crawled out from under the rock. And they're now going on, crypto, getting their flags out. Crypto works. Crypto makes a lot of money. Well, wait a minute. You were only singing when you were winning, and that's the reality. But crypto is at a high just now, and you've got people coming on, and I know somebody personally is doing this. They're coming on saying, they're going on, they're putting posts on with people saying, "Oh, thank you very much for making me another £426,000, in my crypto investment." And I'm like, okay, but is that 426,000 you've actually made in your hand, or is that just the value of your investments have gone up? Because everybody can play that game.
I wonder, Jim, if that's the same person we've got on our
it is. Obviously it is. I don't want to name her.
Well, it's I know I've spoke to her. That's a hack. Her Facebook's been completely hacked, and she can't get back into it. And every time, because I thought that was a bit strange as well. But so that's what that is.
So that Facebook page is wrong, and that's misleading a lot of people.
Oh, definitely.
So our Facebook page has been hacked, but you can see how that could be easily construed, and you could have a lot of people putting a lot of money into crypto as a result of thinking they're going to make hundreds of thousands of pounds worth of money in crypto, when in actual fact, crypto. I actually listened the other day, and this is all emotional decisions, greed, just like what you spoke about. It was I can't remember. It was a billionaire. I was looking at billionaires and just look, and it was Noah Kagan. Noah Kagan actually follows a lot of billionaires and interviews a lot of billionaires. And he asked one of the billionaires, "What's your investments just now?" And he says, "Look, I've got it in property. I've got business interests as well." He says, "I've got other interests in equities and stuff like that." And he says, "I've got in crypto as well." And I went, "Oh, crypto? That's surprising." And he went, "Yeah, but then he qualified it by saying, well, crypto is just a punt. It's not a huge amount, but he says I can afford to lose it. So I'm just taking a punt in crypto, and the fact that if it goes up, it goes up. If I lose it, I lose it, and that's it." So you can see how even a billionaire thinks that crypto is still just it's just a punt, just a wee flurry, like playing on the horses. You're like,
it's a bit like a bet, yeah.
Yeah, if you gamble, you just gamble because you can afford to lose it. That's the only reason you should be gambling. Otherwise, you shouldn't be gambling at all. If you're on the breadline, the last thing you should be doing is gambling. You should be doing dead certs and making sure you're going to get a proper return, and just grind it out like everybody else. And don't assume that you're going to, because this is the whole thing about the lottery: 1 in 15 million chance of winning the lottery. What chance of that? That's absolutely no chance.
Yeah.
But most people actually hedge all their bets on winning the lottery as the way they'll actually set themselves free. And then the next one after that comes, I'll inherit money from someone.
Yeah.
Okay. So who do you want to die?
I know.
Because that's effectively what's going to happen for you to inherit money. You're going to have to die. They're going to have to die. So who do you want to die you're going to inherit money from? So when you put it in that context of winning the lottery, which is pie in the sky stuff, and expecting somebody to die to make it, you've literally got no chance of making anything unless you grind it out and make sure you get some sort of system and some sort of operation or investment strategy that can coherently move you forward and actually over the medium to long term increase your wealth. Increase your wealth, not your income.
Yeah.
Income, remember, is completely taxable. It's money I take out. I am not wanting to increase my income. I want to increase my profit, which is in my business, which will be taxable, but it's not as taxable as what it is when you take it out. So then you take that money and inherit and put it back in. Elaine is going to make a spectacular loss this year. Hallelujah. Honestly, I looked at the numbers and I thought, thank God for that. But because we've invested so much in repairs and improvements overall, what we're doing, almost as much as what she's making, therefore it's going to be a huge loss. Therefore, next year I'm going to be able to carry that loss forward, and I'm going to be able to set it off against a huge gain next year.
Yeah.
That's what I'm looking forward to. So this is proper planning in terms of wealth creation in order to put yourself in the right position. So this is the whole thing about psychological factors. Oh my God, I'm making a huge loss. And I'm like, oh my God, I'm going to offset this against a huge gain next year.
Yeah, turning a negative into a positive and using that to your advantage. And it's true, like you say, Jim, good planning rather than just, and these things that you see like the lottery and inheritance are such common points of reference daily. I mean, people are, oh, when I win the lottery or when I get my inheritance, and hedging all their bets on that rather than strategically planning ahead for their financial future. Definitely. So got some good points there. Let's talk about.
I always like dead sets.
Yeah, definitely. So cognitive biases. So various cognitive biases that affect investors' judgment and decision-making process. We're going to cover just go through them today and kind of hope that makes sense to the whole behavioral finance side of things. And we talk about overconfidence and overconfidence bias. So investors tend to overestimate sometimes their abilities and their accuracy of their predictions. You know, sometimes people could get a bit ahead of themselves, and that could lead them to take really excessive risks and make optimal investments and choices, and then that could be really financially scathing on somebody if you make the wrong financial choice.
How can I bring that back to where I was before? I remember somebody phoning me up out the blue and says, we're going to tank the market because we're ploughing all our money. All the investors have got together in this big fund, and we're all putting our money into this one particular stock and raising the price to a huge point. Whereas in other words, when we take it out, it'll tank it, and we're going to bet against that and manipulate the market.
Okay.
And I'm like, okay, so what are you going to make of it? He says, oh, I think we'll be making 26 million out of this. He was asking for my valuation of his £55,000 flat last week.
Yeah.
Where was the 26 million?
Yeah. So what does that tell you?
Yeah, it all went pear-shaped. But this is what you talk about the overconfidence bias, about they're convinced in their abilities when it's actually maybe just the market is actually making it good. It's not them. This is a good one. Now, the one person I would exclude from this is Linda Martin. This is the people at refurb. Buy and refurb, buy and refurb, buy and refurb, increase the value. And there's a lot of people out there that are increasing their value because they're taking 2 years to do it, and they've been caught in a boom market, and they actually think they've made a fortune. When in actual fact, if they hadn't done anything like Trump and put their money in the bank, they probably would have made just as much money and kept their assets, and actually not made as much of a loss as they've made to where they are now, like Trump.
Yeah, and that's a good example. Like you say, there is exceptions there. Linda Martin's really good at what she does, and property flips and things. But
I've seen that. So it's overconfidence, and then they jump on TikTok. They jump on, and classic example, TikTok. And no offense to anybody in TikTok, I'm speaking to them right now as well. But then they jump on these typical channels and they say, I'm making this amount of money and I'm doing this and I'm doing that. And my first response is, have you actually sold the thing? No, I've not sold it at all. So how could you say you've made it? Because you've not sold it. Oh, I've got a valuation for it. Yeah, okay, but if the market's prepared to pay that and you get that money for it, then you could brag about how much money you're making in that. But you can't. How could you brag? You could say you've added significant value, but there's a definite overconfidence bias where they want to be overconfident and and come up with spurious claims and say it in certain ways, so you pick it up as it's true and gospel in order to sell your course.
Yeah.
That's what happens every single time. There's this guy I saw the other day had Think and Grow Rich, and he had Think and Grow Rich by Dale Carnegie, and he said Think and Grow Rich is a lot of rubbish. You apply all this information, you'll not make any money at all. I says, well, you're talking at your backside, pal, because I've read it 20 times and I'm a multimillionaire as a result of that book. And
did you go back to him, or did you get involved in that? No, or did that you just
no, that's what I said. I basically said that to him online. I basically said it online. I've not heard a word from him. Because he's just trying to get give me attention. Yeah. That's what that's all about. It's like, didn't sit there and say Think and Grow Rich isn't one of the best business books and best wealth creator books ever? Because it is. It teaches you the fundamental core dynamics of what you should be doing in your life and how you should manifest that and use what you've got in a particular way in order to increase your wealth over the medium to long term. That's what Think and Grow Rich is all about. It's an insight into Andrew Carnegie and how he operated. Andrew Carnegie had 300 million in the 1930s.
What? God. Yeah, so in today's money, that's like,
300 million Andrew Carnegie was worth in the 1930s. That is astronomical. That is equivalent to your trillionaires today. Definitely, when you work that out. Andrew Carnegie was huge as a result. Hence the reason why you've got all these Carnegie institutes all around the world, and the Carnegie funds, and everything's named after Carnegie as a result of it. You know, and we're not going to. By the way, we're not going to tear down any of these buildings, are we? No, he was an industrialist. He was this and he was that. Let's tear down his statue. Okay, we'll tear down his libraries and his colleges and his universities. It's like, oh no, we'll not touch them. We just want to tear down his statue. It's like, no, you can't have it both ways.
Yeah, and not to delve too much into that guy with the Think and Grow Rich, but I mean, the question: have you actually read it? Or if he has read it, he's obviously not applied it properly, or maybe he needs to read it again.
You've nailed it straight away there, Richard. People read books and get information, and they say, well, it didn't do anything for me. It didn't do anything for me at all. And then you've got to ask yourself then and ask them, well, did you actually apply that information and knowledge that you learn? And the answer to that is no. Oh, well, I applied it. I applied some of it. All right, okay. Well, I tell you what we'll do. Let's just go and bake a cake, and we'll leave the flour out and we'll leave the eggs out. But we've still got the milk, and we've still got the baking soda, and we've still got whatever it is else that goes into it, the vanilla essence. Do you think we're going to get the same product as before? No, we're never going to get that. And that's exactly what that knowledge and information in these books are. These books are timeless content of people that have been mega wealthy, have put it down in a book format because they never had video at that time and told everybody what they should be doing in order to be mega wealthy. But as human beings, the cognitive basis, the over bias, the emotional that comes into it, it's like the fear of, oh, I've got to talk to somebody then in order for this to succeed. Oh my God, I don't like talking to people on the phone. Hey, just get over it. And if you're uncomfortable, fantastic, you're learning. So be comfortable at being uncomfortable.
Yeah.
There's a saying for you. Be comfortable at being uncomfortable.
Yeah.
Celebrate being uncomfortable, because uncomfortable will get you to riches way beyond your dreams and way beyond where you are, because you'll grow as a natural result of being uncomfortable.
Yeah. A step outside your comfort zone always comes with positive things follow it. And if you do that regularly, you'll come to realize that. So, but yeah, overconfidence bias was what we covered there. And let's go on to loss aversion, Jim. So, I mean, loss aversion, if we think about investors and how they feel the pain of losses more strongly than they maybe feel the pleasure of the equivalent gains. Do you know what I mean? So losses can obviously be quite a big emotional thing for anybody, and it could be a lot more significant than the actual pleasure of having the positive gains.
Absolutely.
So as a result, they may be reluctant to maybe sell potential investments and things that are obviously a loss, or implementing losses to them, and then
it's a phenomenon known as loss aversion. It's the FOMO, the fear of missing out. This is people don't like to lose at stuff. The losing is greater than actually winning. If I said to you, if you did a certain thing, you would get £1,000, okay? You would go, okay, what's that thing going to be? But if I said to you, if you didn't do something, I would take £1,000 off of you, you'd be a bit more up in arms about that, wouldn't you?
Yeah.
So see how the loss is the emotional response for the loss is greater than the emotional response for the gain that you'll get. That's why 95% of the people are actually scratching about in the dirt, wondering where they're going to get their next meal. And that's effectively what it is, because 95% of the people don't value the gain as much as valuing the loss. They're fearful for the loss, so therefore they stop in their tracks as a natural result of that, and they become paralyzed.
Yeah.
And they don't make any decision at all then, because they don't want the loss to happen. So they'd rather avoid the loss and the loss become worse than actually taking the hit for the loss itself and just getting out. Whereas people like Warren Buffett is like, nah, dump the stock. It's like, that's it. That's my exit. When it comes down to that level, we're getting out of this. I can't see anything happening out of this later on. We're going to end up going even down further than that. And as a result, that's what happens. The fear of loss is a classic example as well. Let's take an easy example. Interest rates for me.
Yeah.
I've got variable rates right now. There was a tracker and it was at 10%. Now, people talk to me about the fact that the trackers are going to come down. The Office of Budget Responsibility says inflation is going to come down to 2% in the next couple of months. Therefore, base rates more than likely will start to come down. Therefore, interest rates and mortgage rates will come down as well. Therefore, my trackers will probably come down as well. But there was a deal out there at 4.5% for 3 years. So I just took it for 5 years, actually. So I just took it.
Yeah.
I'm not bothered. Oh, but what if interest rates go down? You've lost. It's like, I couldn't care less.
But then that gives you certainty about what you've got.
Of course it does. My rents on that will go up every 3% every year anyway, and I'll still be paying that 4.5% of that original loan.
Yeah.
Why would I bother? I'm still making money. But I wouldn't. I've now de-risked it and I've taken it out in the calculations. This is what happens when banks, if you borrow off the same bank, okay, anything that's not fixed rate is taken into account in their risk evaluation, because they see that as volatile in terms of this. So they then take that into account and say, okay, we're exposed to X millions with you because none of that is on a fixed rate. Whereas if you've got a fixed rate and they know their numbers and it's there, they don't see that as the calculation when they go to borrow more, to lend more money to you. They actually take that out of the equation completely. So this is another way, and then that goes further. So I mean, we're getting off a bit track of the loss aversion, but it's the fact that you've got to think a bigger picture and how that works out. So you're better to fix the rates and have certainty overall, especially being out from the medium to long term. Why would you want to do anything different? And again, as it takes it out of the equation when it comes to any bank reassessing where you are right now. If you go to a bank and you've got £600 coming in a month and you say, well, the mortgage every single time for the next 5 years is going to be £300 a month, they're going, well, that's a bit of a no-brainer.
Yeah.
If you're a fixed rate, there's £300 every month. You've got a huge margin there for overheads. But if you say that potentially could be open to a variable rate because it's maybe a tracker, then they go, oh, interest rates might actually go up in the next 5 years. So therefore, you might lose that margin and it might squeeze you a bit. Inflation might go up as well as a natural result of that. So that leaves a bit of volatility. So we'll have to take that into account, that you've got an obligation for how much is that loan? Oh, it's like 100,000. Okay. So you're trying to get your exposure to us is not just $1 million now. It's 1.1.
Yeah,
because that 100,000 is in there now. Whereas if it was fixed, it wouldn't be in that calculation because they know that's no exposure anymore because it's a dead set either side of that. So this loss aversion that people get as a natural result of being reluctant to sell and feel the pain of the loss is greater. I took the hit on the Glenrothes office.
Yeah.
I bought that for 210, 40,000 refurb. Had it for, I don't know, 10, 15 years.
A wee bit more than that, about 15 years,
sold it for 200,000. Took a hit about 40 or 50 grand in capital losses. Am I bothered? No, couldn't care less, because I've now got rid of the encumbrant having to have people in it.
All the overhead.
All the gas costs, all the electric costs, all the rate costs, all the repair costs, and the cost of capital that I could use somewhere else. So I've taken that money that I got for that one, the 200,000, and guess what? I bought more buy to let, which I make 25% infinite. Well, I actually make infinite return on this lot because I basically used no money down when I did it. So I'm making an infinite return with the 200,000 I've invested. That's all right.
Yeah. No, that was definitely the right decision at the time, and for the future. But
And then I've got capital losses though of up to 50 grand that I could actually use on anything I sell later on in commercial capacity that I make a huge gain on. So if I make a huge gain, I can offset that loss against it and therefore wipe out the gain.
I see. Right. Okay. But yeah, the loss of everything.
Hence the reason why I said to you about Elaine's got losses this year, not of that capital loss, but of income tax loss.
Yeah.
So therefore, we're able to roll that over to next year, and if we make a ton of money, which we will next year in Elaine's name, then I'll be able to offset these losses that I made the years before deliberately, in order to alleviate that and bring that down to a lower rate taxpayer, if not wipe it out completely. Job done.
Yeah, and that just clearly demonstrates good planning and the advantages of that.
Of course it is.
That was a good example you used about the loss aversion, though, when you said about saying, obviously, I could get you an extra £1,000, or I could take £1,000 from you. And that's how you could see how the emotional response to losing the £1,000 is so much greater than, oh, okay, well, you could show me, maybe let's have a wee look at how I could get the extra 1,000.
Look at it this way. It's like somebody turning up on your doorstep and going, there's a cheque for £1,000. Or somebody could break into your house and just nick the £1,000.
Yeah.
You're going to be jumping at one of them. And it won't be as much. It won't be as much. It'll be the taking money off you.
Yeah, definitely. Good. So let's move on to anchoring bias. And I think this is where investors, well, I know this is where investors really rely too heavily on a specific piece of information, which is referenced as the anchor, when they're making decisions. And even when that information may be irrelevant or maybe outdated, they still remain fixated on that. And that's a really that's an emotional thing as well. I mean, do you have any examples of that, Jim, you could think of that would best demonstrate?
Well, when crypto was tanking, everybody said it was going up.
Yeah, no, that's
and I'm like, am I daft or something? Because I've watched the graph and it's a real-time Bitcoin and it's going down and down and down, and everybody's going, oh, crypto's where it is. It's like it's rocketing on, or they'll hear a soundbite out of what I call a furu, a fake guru. They'll hear a soundbite at a training session they've had, and because they're in the same room with everybody else, and it's the classic example of, you know, what's 1 and 1? It's 4. No, you're wrong. You know what I mean? What's 1 and 1? And you go, it's 2. And they go, no, it's 4. And then you go, no, but I thought it was like, and then they go to the next person and go, what's 1 and 1? And they go, oh yeah, it's 2. And they go, no, it's 4. So it's that classic example about everybody in the room all agreeing at the same time as 1 and 1 equals 4. Therefore, the people that are undecided or on the fence go out and go, yeah, 1 and 1 must be 4 then. It must be. 1 and 1 must be the new 4. That's what it is. 1 and 1 definitely equals 4. And they're running about telling everybody and preaching about it and how wonderful 1 and 1 equals 4 now. And everybody's going, that's 1 and that's 1 and that's 2. I've got 2. It's no 4.
Do you know, that's a really good, we're going to come to in a couple of points as the herding behavior, and that's what that is.
Herd mentality. So, you know, it is often the anchoring basis where people take that soundbite. Now, you can see me now. You know, at the start of the year, I was like, oh, I think unemployment could maybe go up, and I think base rates could go up, and I think inflation could go up. But at this point in time, if the Office of Budget Responsibility has clearly told the Chancellor in the budget in the next couple of months, inflation is going to drop down to 2%, who am I to actually doubt that, considering there's no other evidence anymore to suggest that there's a carry on in the Red Sea still. You know, that doesn't seem to be as prevalent as it was going to be, but it started off like that. And then the Ukraine carry on. You know, that's not had a huge impact on us so far, and it's not continuing to have an impact on us. The Gaza situation with Israel doesn't seem to have a huge impact on us either. So there's no compelling evidence to make me believe that what the Office of Budget Responsibility has said is absolute rubbish. So it can't be. So that's why I believe that if they're saying that and everything looks okay, the number of transactions since 2008, actually every single month, or every single the amount of supply in the market in terms of Fife, but right across the UK, I think, in terms of the housing, the number of houses available for sale is still 40% less than it was in 2008.
Yeah.
So it now tells me there's a restriction in supply still. Therefore, the market in terms of property and should be quite buoyant, and we're not going to see any crashes anytime soon. And I don't think we're even going to go into a buyer's market. I think we're going to go back up into a seller's market more than likely.
That's
If interest rates come down, especially if base rates come down.
That's interesting. I think a lot of people think that is quite an interesting point to make. So that would be one to keep an eye on. It's it's quite interesting listening to you, Jim. And obviously, I put down all the points that we're going to cover today. But as you speak, it just shows that you have a really good grasp on this behavioural finance thing, because you keep picking up on the points that we're about to speak about. I mean, you speak about the situations like the Red Sea and Gaza and the effects that the media's and things are all predicting that they're going to have on us. It kind of falls into this confirmation bias, because it's where information that confirms their existing beliefs or biases while maybe ignoring evidence that contradicts them. So that's So you kind of just covered that there with that example,
so
and that's great.
Confirmation of bias works on the principle that I can see that evidence right in front of me here.
Yeah.
But because I've told a different story, I'm going to go to the evidence that it confirms my story over here. Even though this is blatantly obvious. So that's why I said at the start of the year, this didn't look as good as what I expect. But now, after this has come out and it's in public domain, this information, it's like, why would I not take stock of that now? Why would I just sit and still say there it's going to be different? Which again brings me back on track, because of the information I've now got at hand, as to property prices will be between 1% and 3%. There's no doubt about that. It'll go up 1% and 3% this year if this actually begins to happen as a natural result. But if the Office of Budget Responsibility says to the Chancellor that inflation's going to be at 2% in the next couple of months, if that happens, this will be a natural byproduct of that happening.
Yeah.
So people, confirmation bias is definitely, they'll seek out information. The crypto ones are really bad for it. I'll come back to that again, because it's obviously a flavour of the month now. Because they're on a high, they've got their flags out and they're bunting and everything like that, and they're trying to get everybody else to eat humble pie, when how much has been lost in crypto in the last couple of years.
A lot.
We've no talked about that, have we? We're only talking about we're making so much gains in it. So by the time you notice, by the way, this is how investors work. By the time you notice the market is going up, you're too late. You're too late. You're buying on up. You should have bought when it was going down.
Before,
Yeah. You always buy when the market's going down. So when the market's going down and you believe it's just a cyclical thing, then that's when you're buying on the way down. So you're getting it when it's going up. But you have to be prepared to lose everything as a natural result of that. So classic example, when anything volatile happens and the stock market drops like a stone, I'm in there like a flash buying UK equities all the time, and into my pension, which is the top 100, into my pension definitely, because I know this is just going to rebound in a matter of years anyway. Why would I bother? Because it's a long-term thing for me, and it's a punt. My pension's just a punt. That's all.
Yeah.
It's
and,
like
and
I'm not bored if I lost all my pension. It wouldn't make any difference to me at all. It's my property. It makes all the money.
So at that point, are you putting extra into your pension, and that's true? Is it Standard Life?
Standard Life UK equities, which is classed as an investment category 6 risk, and 7's the highest you'll ever get. And I'm like, really? Diageo, Bat Industries, Glencore Exploration, they're all high risk? I don't think so.
Yeah, so that's quite a good point. But then the confirmation biases things, and it can lead to people having a kind of distorted view on the actual reality, and then in turn they make poor decisions, and poor decision making can be quite detrimental to you financially and things as well.
Yeah, this is a good one. I'll tell you a good one. What I used to do years and years ago. I used to buy a magazine called Investors Chronicle. Most people will know it are Investors Chronicle. It used to tell you all the tips and everything for the stocks to buy and stuff like that. So I started off and I started on going to Investors Chronicle, and I thought, yeah, I'm going to buy stocks. So I bought some of these stocks. I put £200 or £300 in each of them and stuff like that. So, you know, kind of take a punt, prepared to lose it all if that's the case, and thought I'm just going to do what they say. And it was a pile of shite. It was like, it was honestly, it was just a lot of, it was a lot of tosh. It's like, you know, they're talking about, oh, you should buy this stock for this reason because they've got this new silver plaster that you put on your ring, and the healing properties are a lot quicker as a result of it because it's a silver plaster now. And it was a lot of garbage. It's like there was no money to ever be made in these things at all. These were just punts. And people just, you know, oh, this might be a great idea because they're coming out with this great experiment and stuff like that. There's nothing can replace the long-term view of wealth creation built up over a long period of time in incremental compounded values. Nothing is more powerful than that. This short-term get-rich-quick stuff's a lot of tosh.
Yeah.
It's like, you know, for people, maybe you might have, you know, one-offs. I did have a one-off when I ploughed a lot of money into my previous employer, and I owned 2% of the PLC at one point in time. And 3 months later, I sold and I exited at 3 times my investment in 3 months.
Yeah, but that, I mean, that's good, but that's a rare thing.
That was a great day. That was a great. By the way, anybody, it's not insider trading. I was, you know, I was allowed to trade. I checked with the board and everything like that. I was allowed to trade. I was in a period where I was allowed to trade as a result of it. It's not insider information or anything like that because I was removed in one of the sister companies from the PLC itself, and so it was easy for me to do as a natural result of that. But you know, yeah, in 2 or 3 months, you know, it went up 3 times, and I just exited. Now I could have waited and thought, oh. Because it did go up a wee bit more, and I thought, oh, I could have made a lot more. No, I was happy. I was happy as Larry.
Yeah, of course you would be. Yeah,
paid for my place in Spain.
Yeah, but then you think
all my furniture as well.
If you'd taken that risk and held out a wee bit longer, then maybe you would have got a wee bit more. But then you also took the risk that it might have dropped.
Excuse me, that company does not exist today.
Well, there you go. Yeah.
It's non-existent. Basically what happened was I bought at 20 pence, it jumped up to 60 pence a share. I then sold, and then it dropped down to 2 pence a share, and the company is no more.
So that was the right decision.
Yeah, of course it was. I was happy at that level. God, who wouldn't be? Especially with the amount of money I put into it and the return I got on it in such a short space of time. But that was, so I love the idea of going into things that I know. By the way, I phoned everybody at the time and said, all the people I knew, I must have phoned about 100 people and said, you need to buy this stock, you need to buy this stock. I'm investing this amount, I'm investing that amount. One person did that. One person did that. They put 20,000 into it. And then I phoned them up and says, I am exiting now. So in my opinion, you should sell your shares. Yes. So if they sold, they would have made £40,000.
Good.
And that's what it's about. It's about dead certs for me. I like certainty in things, and especially property does that every single time. There's no ambiguity. There's no like ifs and buts about property. It's a formulated equation, and it works every single time. It's a financial freedom blueprint to financial freedom and success over the medium to long term.
Yeah, medium to long term. But no, that's some good examples there, and quite a good story to share, Jim. The next one was herding behaviour, but we've kind of touched on it, and it's where obviously people follow the actions of a crowd without independently really evaluating things and the information for themselves, and that could lead to the formation of like market bubbles and panics, and really you need to think. Let's take a step back and look at it for yourself.
Well, let's look at that. Let's look at that right now. How that works. Look at when there's takeover. So in the city, when you get rumours about takeovers of certain companies, you see the share price go up huge all of a sudden because everybody starts buying into it on the prospect that they might be taking over. And some of it's just a rumour. Look at how Elon Musk was nailed to the wall by the I'm not really sure if it's the FCA in America or the security service. Yeah, security services or something like that. Stock market, security services. He was nailed to the wall because he tweeted something about it would influence the value of his stock as a result of that, and therefore everybody piled in and his stock went sky high as a result of that. Now that was market manipulation.
I was just going to say that's manipulating, yeah.
Yeah, but that's what happens sometimes. This is the herding behavior. This is why you get the influencers on saying, you know, and you follow these influencers and they go, you should buy this and you should buy this. This is the next biggest thing. This is the next new thing. This is what's coming out and this is what's doing here. And we, as this herd mentality, think that we're going to be millionaires next year as a result of it. You know, it's the Del Boy. This time next year we'll be millionaires. It's like, so how much are you putting into it? Oh, well, £10. Well, I don't think you're going to be a millionaire with £10. But we all love to have a flutter, and this is why it happens as a natural result of that. We have this herding behavior to do things. You know, herding behavior. Look at COVID. Everybody just went, oh, moo. It's like, hey, me included. But I made sure that I took a lot of information and advice and actually read up about a lot of stuff before I actually did anything or didn't do anything as a result of that. And at that decision, I took the right decision. In hindsight, they basically said, yeah, the vaccine would have made any difference anyway. And it's like, really? Okay. But and everybody goes, I told you so. And I'm like, I'm not caring. It doesn't matter to me. I couldn't care less. But that's herding mentality. Look at the toilet rolls.
Oh, I know.
People fighting over toilet rolls. Yeah, people fighting over toilet rolls. People fighting over anything. That's the herding behavior, where people panic as a result of it, and therefore everything gets exacerbated and blown out of proportion. And that is another importance of behavioural finance and psychological factors which could influence you to make a horrendous loss at some point in time as a result of as a result of taking the rational decisions. I don't do it anymore. When people go, I've got this great thing, it's like, okay, send it to me and I'll read over it. And then I'll mull it over and then they come back to me, I've got this great thing. Okay, send it to me and I'll read over it. And then at some point in time, I'll go, nah,
not really that great.
I'm not in. Well, look at this. This is not me. So I went round for the second crowdfunding round. The first time I backed out and I said, this is not meat, which is this is not bacon, this is not streaky bacon, this is not pork sausages, this is no caramelized onion sausages. So I went for it again, and I was offered a one-to-one with Andy, one of the owners, because I was going to invest quite heavily in the company again. And then I just left it. I thought, nah, I'm not going to do it. It's a shiny penny to me, and it's diverting me from what I do. I love the idea of having plant-based products, and I really like the product. I use it a lot myself. I eat it a lot myself as well. It's brilliant tasting. Have they got patents? Not really sure, but their margins are really tight. You know, they're going on about their pitch now is like, we've turned over from 5 million to 16 million in 2 years. It's like we've increased our sales. It's like, I couldn't care less about your sales. I just want to know what your bottom line is.
Yeah.
You know, where's your margin? And when people say that about their sales, you usually find they're making a loss and they're not wanting to disclose it. So hence the reason I thought, nah, I'm not interested. I'm just going to waste my time here. And if I've missed that opportunity and they get bought out by a huge organization like Unilever or Procter & Gamble later on, because they've got patents on certain types of products and that, and that probably will be their exit strategy, actually, because I know they're like that, these two guys, and they've done it before with a food truck business, so they'll probably do it again with this as well and have an exit strategy. But I thought to myself, do I really want to get involved in that? Because my core business is property. And it'll just divert me from what I'm doing, because I'll just then go, maybe you should be doing this here and maybe you should be doing that there, and I'll end up getting dragged into the business.
Yeah, and getting it.
Like, how would you like to be on the board of directors? And it's like, oh no, it's like no, I don't want to be on the board of directors. I just want to be a passive investor. So if I'm going to invest in something, I really want to be a bit more involved in it, if that makes sense. So it was a no again second time round.
Yeah.
But you can easily get caught up, because they're ongoing, and the Seeders Fund is actually going up and saying we're 150% oversubscribed. Now, FOMO, loss aversion. Am I missing out on something?
Yeah. And they,
150% of people, they've got more money than they've ever got. Have I missed something here? Have I not seen something here? It's like, no, you've not. It's just that everybody's got this loss aversion. They're afraid to miss out, so they're just putting money into it for the sake of it.
yeah. And that's when companies, and it's all about smoke and mirrors, because it's like, oh, and they look like they're obviously performing brilliantly on the surface, but really, like you say, what's their bottom line? What's your margins?
Yeah,
And they're not that great at all.
absolutely.
Yeah.
Absolutely, I would say that, definitely.
Yeah. Very good. So, well, let's talk about sentiment. And behavioral finance considers like the influence of people and investors' sentiment, which refers to like their overall attitude or mood to investors have towards maybe the market in a particular asset. We'll talk about property probably here. And sentiment can really impact market prices and lead to fluctuations maybe beyond what the fundamentals might suggest.
Oh, we've got a perfect example here, 2008.
I'm just going to say, Jim, you got an example for that?
Yeah, 2008, investor sentiment. The
Yep.
property market. Everybody was convinced the property market was going to tank. Therefore, a lot of people dumped their property onto the market, about 6% more than usual of the housing stock went onto the market all at the same time. And therefore, as a result, there was a huge influx of oversupply. The value of property dropped as a natural result. Therefore, the loan to values increased in terms, and the exposure that the banks had to the loss was so great that they couldn't keep within their tolerance limits. Therefore, they had to then take action and start to dump lending, dump stocks, dump their loans, basically sell off all these toxic loans to someone else. Now, while this other company was going, yeah, I'll give you 20 pence in the pound for it, they were taking all these hits and losses, and therefore it was affecting the market even more. And therefore they weren't able to lend to the to people buying properties anymore as a result of it, or if they were lending, they were having to take huge amount of equity as trust, because they were terrified of that. Some of them just stopped lending completely. Therefore, all the mortgages and finance dropped, dried up as a result. Therefore, all these properties still sat in the market waiting for sale, and they continued to decrease in value, because nobody was buying them. And that's what happens to stock. It decreases in value every single time until somebody jumps in, a bit like bid up TV. So you can imagine that market in 2008 was a bit like bid up TV, where the prices were continually coming down and down and down and down and down, where people had money were going, right, now is the time to buy. See what I mean about buying on the way down?
Buy on the way down, yeah. And for those of you that maybe are unsure, obviously 2008 is just on the back of when Northern Rock went bust and went to the wall with everything. And that's the market influence that had on.
If you watch the big short or something like that, which is the film about it.
I think it
talks about how it worked, and it was basically because they were taking risks, and they were just betting on things happening. I'll bet you that this price of this stock won't go down. Oh, well, I'll bet you this price of the stock will go up. And it's like, that's what they were doing. It was intangible money they were betting on, and just creating stuff out of nowhere with all this. And they were overflating in the value of their companies, and then they were inflating the value of the tolerance they had to take on more debt as a result of that. And then once that was all exposed, that's why it all came crashing down as a natural result of that.
Correct me if I'm wrong, because obviously I wasn't. But I mean, am I right in saying that they were doing lending at like 125% and things? And
yeah, Northern Rock were doing lending at 125% on the premise that property will go up by 25% over the next 2 or 3 years, because at that time it was starting to go up from 2000 to 2006 at an extraordinary rate, exactly what was happening now. And there was no tolerance, and there was no there was no stress testing. That was the word. There was no stress testing involved at that time. They were no saying, well, if interest rates for you as a seller and you're getting a mortgage from us, if interest rates went up by 5%, would you still be able to afford it? There was nothing like that done at all. They were literally just giving mortgages to people on benefits in America. People on benefits, and they were giving mortgages to buy their houses, and without any checking or tolerance or limits at all as a result of that. And that's why that happened. But the cascading effect from the toxic loans, and what they did was they hid all these subprime and toxic loans in good quality loans. So they packaged them all up, and basically like a Jenga tower, if you imagine all that, and the toxic loans were in there as well. And what happens is the toxic loans fell apart, and then that's as a result they all came out the Jenga tower, and the tower just collapsed. Yeah. So what they were packaging out was they were hiding them all, and they were giving them AAA ratings. You know, Standard and Poor's and Moody's were giving them AAA ratings, which is they should have been taken to task, but they never were as a result of that. The Big Short, there you go. Peter says it. Better watching The Big Short. That's the film, definitely. So The Big Short, Christian Bale, I think, is in here, and he's the one that actually identifies and realizes what's going on. And as well as the actor, know him personally, but he's the one who identifies what's going on, and the actual and Lehman's and stuff like that. They're betting against each other. The same people in the same company are betting against each other. So therefore, if you've got two people betting against each other in the same company, if one wins, one loses. So you've not actually won anything. And this is what he identified was going on, and default credit swaps. So this is what it was called. It still goes on, believe it or not. It's just called by a different name, and we don't get told about it. But it still happens. It still happens. It's still allowed to happen. And it's because bankers want more bonuses, and because they've taken that threshold off now about the restriction in bonuses for bankers, you'll see it probably happening a lot more as a result of that. But you know, it'll take a generation for it to disappear, and I think we're near that in the next 10 years. We'll go through the same turmoil again, more than likely, as a result of what we're doing. So investor sentiment definitely is the attitude and mood of investors, and how everybody piles in as a result, and that pushes the price up or down as a natural result of what's happening overall.
Yeah, thanks for that. So what about Gary's jumping in? He says it seems crazy looking back that they did that.
Absolutely.
It is really crazy, Gary, I know.
Well, I could have told them straight away. As soon as you got Northern Rock offering 125%, I went, that can't be right. When I sat in front of my mortgage broker, and I says, that can't be right. There's no way I'm taking that. That's just stupidity. I was training to be an accountant at the time, and even I realised that. But I never knew it was going mass across the scale. Banks were doing that, and it was literally just to multiply their income and their asset value as a result of doing that. We'll give you more money than you've ever had. And then I said to the guy, I said, the mortgage broker, I said, so what will I spend the extra 25% on? He went, just buy a car.
Really?
Why? Oh, a depreciating asset. I'm not buying a car. It's like, I'm going to take my house and borrow another 25% over and above on the house. So I've not even got that gain yet in the house. And I'm going to buy a car, which depreciates in value. So the 25% I've just borrowed out, which I'm going to have to get back in the increase in the value, is going to be lost on a car. No chance.
Yeah. And the knock-on effect for that, obviously, right across America was obviously foreclosure and repossession here in Britain. So, yeah. What about prospect theory, Jim? You want to tell us a wee bit about prospect theory?
Oh, this suggests that individuals evaluate potential outcomes relative to the reference point and exhibit risk aversion for gains, but risk-seeking behaviour for losses.
Right.
This is asymmetric and decision-making contradicts the traditional economic assumption of risk neutrality. So,
this is why I let you cover this one.
Gold is in them their hills.
Right, okay.
Let's put all our money into them their hills as much as we can because we believe gold's there. Well, have you actually done any geological surveys or anything? No, but I just think it's there. So let's just play. It's effectively gambling. You have this hunch overall in prospect theory that the potential outcomes when you is going to be greater, and it's just this hunch. Crypto, crypto's getting a beating today, but it deserves it.
Well, yeah, that's what I have to say.
Crypto's eventually just, it's just gambling. Let's be honest. Nobody's making any money out of crypto except the people running the crypto exchanges. This is what you don't realize. When people tell you how to beat the online casinos, they're not doing it to tell you how to beat the online casinos. They're putting their cookie in your system, so use their system. So they're getting a percentage of everything you're betting every single time, and that's where they make their money. They're not doing it for free. They're getting you to use their system. When people like Greg Secker ask you to do currency trading, and you go on Greg's course, now Greg's absolutely fantastic currency trading, and he's showing it all the time as a result of what he's doing. And I've got every respect for Greg Secker and what he does. But there's no doubt about it. I'm sure that Greg's got his own system that everybody uses, that he'll get a small percentage off every time they make a trade. This is like the cards. You know, the guy that comes along and says, how did you make your money with his Bentley or his Ferrari? How did you make your money? See all the dentists in America? Well, they use my systems. They use my card system in order to do a transaction. And I just get, I get 1 cent off of every transaction on all the dentists in America as a result of it. Therefore, that's how I make my money, because I made that system for them. And he only gets 1 cent on every single transaction, but it's every single dentist in America. That's why he is a billionaire.
And that'll compound.
And that's what prospect theory is all about. People want to get you into prospect theory to sell you a system that will actually make them money.
Yeah, and that kind of that really would compound up to be a lot over time. And that would make somebody really wealthy. Yeah.
Yeah, Peter says there, Bitcoin's at an all-time high today. That's when you're not to buy it. That's when you don't buy Bitcoin. You wait until it goes down again, and then you buy it and you take a punt. That's it.
Lucinda's jumped in the comments and says, what exactly is crypto? I've never really understood it. Probably for the best, Lucinda, to be fair.
It's an intangible product. It's held as a numerical code in a system which you can use as a currency exchange with someone else for that intangible product. It's kind of like the money in your pocket, but this is what we adopt as, you know, as exchange, money, monetary value. This is what crypto is, but it's not used by everybody universally. But it's untraceable crypto, and that's why you usually typically get people that want to launder money to use crypto. That's why garages go, yeah, we're happy. If you want to pay for your Ferrari in crypto, we'll take the crypto. They'll probably just exchange it right out straight away, but they're no bothered because the crypto is a method of laundering money at this point in time. It is not traceable, and that's why you know, people, but other people just hold crypto in order to pretend to themselves that they're making a fortune. Look at look at the kickboxer that lost 26 million in 1 year on crypto, put all his earnings into crypto, lost the whole lot when it tanked, disappeared, gone. And it wasn't a Bitcoin, it was some sort of, you know, how's your daddy, fairy Bitcoin thing. You know, it was called something daft. It's like, you know, fairy crypto, another version of Bitcoin, and that disappeared as a result. But the people making money on crypto is the exchange companies doing crypto. Yeah,
they're the ones that are going to come out on top of that. And Gary's saying a little bit of knowledge is dangerous with crypto, so he's happy to know sod all about it, and that's probably the best approach, Gary, to be honest. The less you know about it, the better, because it really is.
Unless you're prepared to take the loss. If you're prepared to take the loss, then go for it. If you're prepared to take the loss, but I wouldn't be buying crypto at this point in time when it's an all-time high. I'd just wait for it to tank again, and then I would invest in Bitcoin again. Bitcoin seems to be the standard, so I'd invest in Bitcoin again. But then you've got Bitcoin exchanges, and then the Bitcoin exchanges hold your money as a natural result, and that's why that one tanked and billions of pounds were lost of everybody's money, because they couldn't find it because Sam Friedman or whatever his name was had spent a lot.
Spent it all, yeah.
Aye. Oh God. Oh dear.
So yeah, behavioural finance, and we've covered quite a lot of good examples today, Jim. So thanks for that. But I think really understanding behavioural finance can really help investors and financial professionals make better investment decisions. And really, by recognising and mitigating the cognitive biases that we've covered, investors can avoid a lot of the common pitfalls and improve the long-term investment outcomes. And financial institutions can also use insights from behavioural finance to kind of design better products and services that really align with the needs and preferences of their client, and depending on what.
Definitely. Just to finish off in crypto, I see Peter on TikTok says, I've been buying it every month for the past few years, so it's doing well. Need to learn to sell. Yes, that's exactly what you should be doing at this point in time. If you're if you've made a really good return, Peter, I would be cashing out right now. The problem is, how do you cash out?
That's what I was just going to say.
You have to get somebody else to buy it.
How do you actually cash out with crypto then?
There's not a bank that says I'll take that money back.
Yeah, and exchange it for actual sterling.
It's like the when I got involved in the put it on red every single time and double your bet every single time. You know, the winner, the what the banker knows. That's apparently what it is. And I was up to 800 quid at one point with £200 investment, and I tried to cash it out, and they wouldn't have let me. And I ended up losing the whole lot. So it's like, I'm not letting you leave the table. But I was prepared to lose the 200 quid to prove the point of it's not. And it transpired that the number of bets I made came to about 163,000 in total. And he got 1% every single bit of that.
So all right, okay.
So he got 1,630 quid, and I only lost £200. But he got money on every single bet it was made.
So there's the one.
See how that worked?
Yeah.
So that's why he says, that's why he does beat the banker and use my system, because he's now got a cookie or an affiliate link embedded into that, and that's where he makes his money. That person that runs Beat the Banker, but it'll not be a person; it'll be a huge multinational company that runs that in order to do that. Or worse still, it's probably a militant, group in some Middle Eastern country that maybe has that. It's actually operating that system and make money out of it as a result of what you're doing. So you've got to be very careful about what you're investing your money in, and you need to learn to know there's a proper exit strategy if you need it.
Yeah, definitely.
First question I ask every single time, Richard. The first question I ask every single time: if I put my money into this, how easy is it for me to get it out, or how easy is it for me to exit? Classic example about why do you buy property at 300,000 and 400,000? Because obviously it's less hassle. Do you know how difficult it is to sell a property at 300,000 and 400,000 now, as opposed to a property up to 100,000? It's really easy to exit now, and everything up to 100,000 right now will go quite well in the next couple of years. It will be very, very good.
That all comes back to planning and risk analysis.
Understanding.
You need to look at your exit strategy and how easy that would be.
Understanding the market. Understanding the market. As interest rates go high, lower value properties actually increase exponentially in proportion to the higher value properties, because interest rates are going so high and affordability drops as a result of that. So a lot more people go for these properties.
Yeah.
And then that's when, if you're going to do anything, that's when if you've got to leverage yourself, that's when to do it. Because obviously you've got a lot of equity in there as a result of the inflated high value, because it's on a high now. That's when you do it, and then reinvest back in the business and buy more property. Don't go and buy a Ferrari, for God's sake. It's like, because you've just taken the money out and killed it. Because if you buy more property, then really what's happening right here is your loan to value will still be the same, because you've still got the same money in the business and the same equity as a result of it. All you're doing is buying more property. But your income is going up as a natural result of it as well. Your income every single month, because you're buying more property, generating more income every month as a result.
You've still got that equity, and you're increasing your cash flow and your income.
Yeah, I read somebody was saying, I bought 40 properties in 4 years, learning how to do this, and everybody's raving about him online now, and he's on TikTok and everything, and all these podcasts have got him on there, and they're jumping for joy. I think he runs a financial services firm. So I looked at his balance sheet, and he's negative £85,000. He's got £900,000 worth of property, but he's got £1 million worth of debt. That's not a good situation to be in, especially if there's going to be a bit of volatility. Now he's maybe locked in. There's maybe unrealized gains in there, which is equity, which is maybe it's a lot more value than it is. But he says he's only done it from a standing start in 4 years. So he's no built up anything in 4 years really, except maybe a 30% increase. That could take account of that, but that could easily disappear in the short term. That could leave him really exposed to a bank if they said, "We need you to bring your equity, your loan to value down to 60%.
Yeah, I've just got that leaves him wide open.
Every single bank's got that written into their terms now. Whatever you borrowed it, they deliberately put into their terms now that they can come to you and say, "We want you to bring your loan to value now down to X percentage," whatever that is. Read your small print, people. Hence the reason why I sit at 35, 40, 45% is equity of mine in all my investments to now, because I'm very, very cautious right now about, ever seeing something on the horizon coming along, and I'm happy at that sort of level of tolerance.
Good. So I think overall today we've covered obviously behavioural finance really provides a comprehensive kind of framework for understanding how the psychological and the emotional factors influence your financial decision making, and really challenging the assumptions of traditional finance theory and offering valuable insights which allow investors to make more informed decisions and potentially mitigate the negative effects of irrational behaviour in the financial markets.
Definitely. We'll leave the last word with Davey, who says on TikTok, "You can't take it with you."
Yep.
You want a bet?
Definitely.
You want a bet, Davey? I can take it with me.
Yeah.
But I'll pass it on to my daughter, my sons, and generational wealth.
Yeah.
That's exactly what it is. And to me, that is, you can take it with you, because literally that is my sons and daughter is actually me and my wife. That's they are, that is us. So I literally can say, yes, I can take it with me, because it goes to my sons and my daughter.
We spoke about a couple of weeks ago, and I couldn't think of the word, and it was you leaving in trust. Do you have trust in things, trust in that setup, Jim?
Well, the one I'm going, National Federation of Residential Landlords have got a fantastic course about inheritance tax planning, and I've actually signed up for that yesterday. And it talks about family investment vehicles, family investment companies as well. So I'm intrigued to find out all about these sort of things. Again, this is just knowledge and expertise gained over time. This is just a way to learn from other people as a result. And I enjoy the journey of learning and being a student of life, and understanding how to do this.
Yeah, well, that'll be interesting. Remind me once you've been on that, we could maybe pick your brain about what you learned on that, and you can maybe share some of that, because that's quite an interesting topic, definitely.
Yeah, Peter says that I hope the future generations don't squander wealth. If they're taught right, they won't. And my lot's a lot more prudent than I was. Christ almighty, they've got.
It's because you've taught them that.
Yeah, I think, and yeah, I've not sat them down and taught them it, but it's lead by example.
Yeah.
So they can see what I've done, they can see how I do things, they can see how I act. I have now and again says, look, stay with your mum and dad. You get free food, you get free lodging, you pay for nothing, you've got free heating, you've got the best of everything, and just build your wealth. Yeah. So eventually, when you do go to buy a house and invest now in things like the First Home Fund, which they're all nearly at the end of the First Home Fund after the 4 or 5 years they've built up. So they've got the full amount to go and buy, and they'll get £3,000 off the government to go and buy their first house if they want. So these are all the things to invest in, plus their pensions as well. It's like flipping heck. It's like they've got their head screwed on. Definitely.
It's a good setup. Yeah.
I don't, and Tony still switches off the heating when she goes in her house. It's that's the it's like, wait a minute, Tony, you could have all that if you want. It's like, no, the heating, I'm not keeping the heating on because it costs money. It's like, okay, it's a frugal way to be. You don't need to be like that, really, but hey, you've learned the lesson.
Yeah, definitely. And Lucinda says, explain as you go and they learn as they grow.
Definitely. And on that note, thanks very much for coming on. Richard, thanks very much for taking part and everything like that. And we'll leave it at that.
Yeah, thanks everyone. That's great. We'll leave it there, and we'll be back next Monday at 12:30.